In this, the seventh lesson of the Henry George School of Social Science course, Understanding Our Political Economy, we acknowledge that the political obstacles, as well as the ongoing problems associated with mainstream academic teaching, require a multifaceted and transitional approach to achieving systemic change. One of the great tragedies of modern civilizations is that governments everywhere obtain most revenue from sources that should not be taxed or taxed very lightly. The first reason for fundamental change is for the reason of justice. Income earned by producing goods or providing services to others is legitimate individual property that should not be confiscated via taxation by government. The second reason is that such taxation has negative consequences for a society's economy. This course has presented the case that an understanding of political economy is possible only by embracing the three-factor model of wealth production and distribution. Land is a factor of production with characteristics quite distinct from those of labor, capital goods, or even credit. Public policy must recognize these distinctions by implementing the societal collection of the rent fund associated with the value of land in its broadest definition. To respond to the main arguments found in opposition to this conclusion was the objective of Henry George's final work, The Science of Political Economy, published posthumously in 1898. In the preface, he explained his reasoning. In Progress and Poverty, I recast political economy in what were at the time the points which most needed recasting. Criticism has but shown the soundness of the views there expressed. But Progress and Poverty did not cover the whole field of political economy and was necessarily in large measure of a controversial rather than of a constructive nature. To do more than this was at the time beyond the leisure at my command, nor did I see fully the necessity. For while I realized the greatness of the forces which would throw themselves against the simple truth which I endeavored to make clear, I did not think that should Progress and Poverty succeed in commanding anything like wide attention, there would be at least some of the professed teachers of political economy who, recognizing the ignored truths, would fit them in with what of truth was already understood and taught. Events of the 20th century resulted in public policies that reacted to one form of stress after another. In every society, the pressures of financial panics, civil or global war, prolonged economic depression, ideological or religious divide, as well as natural and environmental disasters, resulted in the transfer of political decision-making to national government. Today, the national government of nearly every society taxes individual incomes, business profits, gains on the sale of assets, and, where value-added taxes are imposed, on the sale of goods. As has been emphasized in this course, most of these taxes impose a heavy burden on the output of goods and services. Tax laws make almost no distinction between income that is earned by actually producing goods and providing services and unearned, obtained by speculation in land, natural resources, financial instruments, and other legal claims on property. There have been a number of proposals to restructure the individual income tax, the most common being an attempt to combine tax simplification with equalization as a percentage of income. The calls are for a flat tax. Critics argue that a flat tax is regressive. More significantly, it would leave untaxed the huge amount of income that is speculation-derived and unearned. Although roughly 44% of all persons in the United States who filed a tax return in 2018 paid no federal income tax, many work and contribute to Social Security and Medicare. Of course, those at the top have enjoyed huge reductions in federal taxation at a time in our history when federal spending has skyrocketed and when income is ever more concentrated at the top. What we now offer is another alternative. a proposal for a simplified but progressive tax structure that would shift the burden of taxation more heavily onto unearned income flows, a high percentage of which is rent-derived. The heart of this proposal is that all individual incomes up to the national median or state median in states that tax income would be exempt from taxation. To achieve tax simplification, there would be no other exemptions or deductions permitted. A 2018 report issued by the Economic Policy Institute indicates that a household income of $422,000 is required to be among the top 1% of U.S. earners. The bottom 99% have an average household income of just $50,100. The median household income reported to be $63,200. So, what should reform of the income tax look like? The first change we propose is to exempt all individual incomes up to the national median. The national median is well above the poverty level, but is still a very modest income. The real median personal income for 2018, as reported by the Federal Reserve Bank of St. Louis, was $33,706. All incomes up to the national median would be exempt from taxation. There would be no other exemptions or deductions under the tax code. Individuals with special hardships would apply for assistance from the appropriate social welfare agencies. Above the national median, higher ranges of income would be taxed at increasing rates sufficient to balance the federal budget. Included in the annual budget would be the amount required to service and pay down the national debt. This would be accomplished over several decades by refunding all maturing government bonds with fully amortizing bonds that return both interest and principal to investors. For convenience, we will use U.S. dollars to provide an example of the progressivity of this approach to raising public revenue by taxing individual income. The U.S. Congress would have to determine the tax rates and ranges of income subject to each rate as part of the budgeting process, ideally with the objective of raising sufficient revenue to balance the budget. Again, this revenue objective would include funds to begin repayment of the nation's outstanding debt. For purposes of example, let's assume the progressivity of rates would be as follows. Here, for purposes of example only, is how the new structure might work. Above $33,706 up to $75,000, the rate would be 5%. Above $75,000 up to $150,000, 10%. Above $150,000 to $300,000, 15%. Above $300,000 up to $500,000, 20%. These modest rates of taxation cover the overwhelming majority of taxpayers in the United States who earn the great majority of their incomes by economically productive activities, producing goods or providing services. Above this level, almost all incomes are derived from passive investment activity and from speculation in the stock, bond, and commodities markets, in precious metals, in property, and in land. Above $500,000 up to $1 million, 25% would be the tax rate. Above $1 million up to $5 million, 30%. Above $5 million up to $10 million, 35%. Above $10 million up to $25 million, 40%, and so on. Depending upon revenue needs, the federal government may need to return to the highest marginal tax rates in effect up until the 1970s. There would be no special rates applied to income derived from the sale of assets, so-called capital gains, for one simple reason. Actual capital goods rarely sell for more than their cost of acquisition. Capital goods depreciate over time. What is today called a capital gain is almost always a gain derived from rent-seeking speculation in financial and other markets. If we are to continue to raise revenue by taxing business entities, then a similar graduated tax structure could be implemented to encourage both job creation and efficiency. Inasmuch as most new jobs are created by small businesses with stronger ties to the communities in which they operate, we ought to encourage small businesses by exempting them from taxation. One way to achieve this objective is to abandon the business profits tax in favor of a low, graduated rate of taxation on gross revenue. Again, as an example of how this progressive structure would work, and again, for purposes of example, business revenue up to, say, $500,000 would be exempt from taxation. Revenue greater than $500,000 up to $2 million would be taxed at 1%. Revenue greater than $2 million up to $5 million would be taxed at 1.5%. Revenue greater than $5 million up to $25 million would be taxed at 2%, and so on. Other than the basic exemption of the first $500,000 in revenue, there would be no other deductions for expenses incurred. This would mean that efficient businesses with lower expenses per unit of revenue would be rewarded with higher profits. Companies would no longer be able to expense the compensation packages awarded to executives, eliminating the existing benefit of passing on the costs onto other taxpayers. Roughly 60% of all working people in the United States would be exempt from federal taxation under the simplified progressive income tax proposed. It is important to remember that the above analysis is merely an example based on arbitrary rates applied to those ranges of income. To make the structure even more progressive, the amount of income exempted could be set at 150% or 200% of the national median. Two-income households would experience significant increases in disposable income as a result. Unfortunately, there are too few people protesting against the low taxes levied on the nation's landed interests. Reform of our federal income tax system is at least being discussed. Getting back to the principle offered and the rates proposed, the tax obligation of those with incomes of $250,000 and above, those who derive a higher and higher proportion of their income from ownership of land and natural resources, would be as follows. Only 2.3 million households have incomes above $250,000. Individuals with incomes of $500,000 would pay $71,900 in taxes. Individuals with incomes of $1 million would pay just $196,900 in taxes. Individuals with incomes of $5 million would pay $1,396,900 in taxes. Some 112,400 households have incomes above $5 million. An individual with an income of $10 million would pay $3,146,900 in taxes. The rest of any necessary tax revenue, should political economy teaches, come from those at the very top whose income is not available in the public records. As of 2018, there are 607 billionaires who are U.S. citizens. Around the globe, there are some 2,600 billionaires, whose aggregate net worth is estimated to be $8.6 trillion. There are no silver bullets that can be fired to solve the numerous problems faced by the peoples of our planet. What history makes clear to us is that the failure to utilize the knowledge revealed by the science of political economy has doomed us to repeating cycles of boom and bust, an accelerating concentration of income and wealth, patterns of land use that not only threaten food production, but continue to result in serious pollution of the land, air, and water. In the concluding chapter of Progress and Poverty, Henry George left readers with this picture of a future that threatened the very survival of civilization. Human progress is not the improvement of human nature. The advances in which civilization consists are not secured in the constitution of man, but in the constitution of society. They are thus not fixed and permanent, but may at any time be lost, nay, are constantly tending to be lost. And with that quote from Henry George, we've reached the end of the final lesson of the course, Understanding Our Political Economy.